Okay, this is the second video of this practice problem having to do with a company that has an 80-20 split between the controlling and non-controlling. And video 1 covers all the entries we'd make at the date of acquisition. It also calculated the goodwill, and because there's a control premium, although it's an 80-20 split, the goodwill and anything having to do with goodwill will be divided 87 and 13. We also, in this first video, created the table that showed there were two undervalued assets. Their amortization or depreciation is listed here. The total effect on the income statement, and we are going to do the income for year 1, is going to be $40,000 for the parent and the consolidation. Now this video is going to cover the next part, which is what happens at the end of year 1. So the first thing we have to do, here's the parent and the sub. So the first thing we have to do, make sure we have our prep work done. So we have our sheet calculated, and I have put goodwill there because there's no impairment. In some problems there might be impairment. The second thing we have to do is calculate equity income. And I started out by going to my worksheet and finding the equity income. There it is. And I put that here. I subtracted the 10,000 and the 13,000. Let me make that a little bit lighter. 10,000, 30,000. Those are right here. So I got 170,000 for net income. And I want to stress that this is net income. For convenience, I'm going to look at the impact on the investment, but everything above the gray is the net income. So here's the 80% of each of those items leading to 136, and here's the 20% non-controlling, and that's going to lead to 34,000. So we need to make the entries. We could go ahead and calculate how we got this equity income amount, equity investment amount, but I'm not going to do that. Hopefully you would do that. We're just going to go ahead and make the entries that we need to make to do the consolidation. So that we have to eliminate all of this current stuff that's happened on the parents' books, and we have to indicate, well, we're going to combine all the income, but not all the income should be combined in the consolidation. Some of it has to be attributed to the non-controlling interests. So we're going to make 2 journal entries. They can be combined in one. And the first is just, again, that equity income. Can't report it twice. So I'm going to stick with this column first. And we'll do the second column. And the equity income portion is 136,000. We have that temporary dividend account. The cash is still in the consolidated, so we don't really have dividends. If you go down here, you can see that 16,800 is the share of those 21,000 in dividends. So 16,800. And that leaves a change in the investment that must be undone, the equity investment, of 119,200. So we'll get rid of all this bright color. It's these numbers that we're going to use: the net income, the dividends, and the impact on the investment. And then we're going to do the same thing, looking at the net income effect for the non-controlling. And we're going to use these 3 numbers right here. So that is 34,000. Dividends, the rest of the dividends, 4,200. And the non-controlling effect or interest in the total ownership or the total value of the firm is going to be $29,800. That's the change this year. Some people combine these because the dividends could be combined, right? So we could have two debits, the equity investment for the controlling interest, equity income for the controlling interest, and the income for the non-controlling interest. We could combine the dividends, adding up to the total amount, which was $21,000, and then the equity investment and the non-controlling interest in the total value of the sub. I'm not going to make that joint entry, but you could make it. Now, we also need to do the restatement. And by that, we're going to increase the property, plant, and equipment. We're going to recognize those intangibles. We're going to recognize the goodwill. And we have to decide how much of that is attributable to the equity investment of the controlling majority ownership, and how much is non-controlling interest in the increase in these assets. We get this right off the table, $500,000. Intangibles, $300,000. Goodwill, we calculated that at the beginning of the problem. Now the important thing to recognize is this is 80%, this is 80%, but we're only going to allocate, or we are going to allocate 87% of the 150. So let's see, 0.8 times the 500, 0.8 times the 300,000, and then 0.87 times the goodwill. I'm going to add those together, and that is going to be the amount that we credit for the investment, the equity investment. Yep. And then the rest, which we can do over here if we want, 0.2 times the 500,000, 0.2 times the 300,000, and 0.2 times, 0.13 times the goodwill. 87% here, the remaining 13% here. We'll use the auto sum. 179,500. Oops, before the restatement, I should have done the elimination. So just move these in the opposite direction. Oh, that was weird. There was another cell there. Okay, so let's do the elimination. We're eliminating the beginning common stock, the beginning additional paid-in capital, and the retained earnings from the beginning of the year. And we could take that right off our sheets, our worksheets. So we have common stock 100, 125. And the beginning of the year retained earnings, 775. All right. That adds up to $1 million. Excuse me. So that's easy enough to divide between the equity investment, which is going to be just a straight 80%, and the non-controlling interest in that share of the net assets, really, of the shareholders' equity. That's going to be $200,000. sure we got all our zeros and our commas in the right place. Very good. All right, finally, we have to do the operating expenses and the PP&E. Now, sometimes you'll look up here at the worksheet and you'll see that they're actually splitting them into depreciation expense, amortization expense, but here they've got them all in operating expenses. So we know we have 40,000, the 10 and the 30,000 from our original table. 10,000 of that is a reduction in the PP&E. Of course, normally that would be through the accumulated depreciation. And then intangibles. I've got to go back and respell that because that says intangibles. There we go. All right, so now we're done. This is all going to be included in the answer key, and it will be put in the folder for you. You can, and I hope you do, go ahead and post. That's in the answer, and prepare some statements.